Learning objectives. At the end of this concept, you will be able to identify the components of the balance sheet, explain the impact of each transaction on the components of the balance sheet, identify reasons why a balance sheet always balances. Ted is the manager of Smart Fashions, who are into the business of making and selling garments. He takes a showroom on rent for the business and moves in. First, he buys furniture, and next he acquires the stock. Now that the showroom is fully stocked and nicely decorated, he is all set for business. The shoppers keep pouring in and sales are up. Ted is really happy counting the money. With the sales being up, Ted feels the need for a company car to help the business, so he buys one. It is 3 months from the time the business started. Ted needs to know where the business stands, and he finds all his answers in the balance sheet. Ted will share with you the balance sheet of Smart Fashions so that the concept becomes clear to you. Assets, liabilities, and capital are the 3 components of the balance sheet. The possessions of the firm which result in future economic benefit are assets. For example, the machines, furniture, textiles, car, cash, and fixed deposits possessed by Smart Fashions are all assets. The firm has full rights over receivables and prepaid expenses, which result in future economic benefits, and therefore these are also treated as assets. Any fund put into the business by the owners is capital. The funds provided by outside agencies, such as a bank, are liabilities for the business. Goods received by the business for which the firm is liable to pay is also termed liabilities. The unique feature of the balance sheet is that at any given point in time, all business assets are equal to business liabilities plus capital. To understand how a balance sheet is prepared, let's look at 12 business transactions of Smart Fashions over one financial quarter. On 2nd January, Ted receives €25,000 from his father Ben to start Smart Fashions. This amount introduces capital into the business, which increases the liabilities. The amount is then deposited in a bank, which increases the assets. Both sides of the balance sheet add up to the same total of €25,000. On 5th January, Smart Fashions pays €20,000 as a rental deposit for the shop. A new type of asset, rental deposit, appears in the accounts. This increases the total assets. However, the reduction in the bank balance decreases the total assets. Again, both sides of the balance sheet total €25,000. On 8th January, Smart Fashions purchases sewing machines worth €1,000. The new machines increase the total assets. The reduction in cash at the bank decreases the total assets. Both sides of the balance sheet still total €25,000. On 10th January, Alex invested €25,000 in Smart Fashions. The amount brings additional capital into the business, which increases the liabilities. The increase in cash at the bank increases the total assets. Both sides of the balance sheet now total €50,000. On 1st February, Smart Fashions purchases furniture worth €10,000. The furniture purchase increases the total assets. The reduction in cash at the bank decreases the total assets. Both sides of the balance sheet still total €50,000. On 3rd February, Smart Fashions takes a car loan of €20,000 with the bank. The bank loan increases the total liabilities. The car purchase increases the total assets. Both sides of the balance sheet now total €70,000. On 6 February, Smart Fashions transfers €3,000 to a fixed deposit account. A new type of asset, fixed deposit, is created, which increases the total assets. However, the cash at the bank reduces by €3,000, which decreases the total assets. Both sides of the balance sheet still total €70,000. On 15th February, Smart Fashions pays an insurance premium of €1,000 for the coming quarter. A new type of asset, prepaid insurance, is created, which increases the total assets. The reduction in cash at the bank decreases the total assets. Both sides of the balance sheet still total €70,000. On 7th March, Smart Fashions purchases textiles on credit worth €8,000 from Sam Textiles. The credit purchase creates a liability in the name of Sam Textiles, which increases the total liabilities. Textiles is added as stock, which increases the total assets. Both sides of the balance sheet now total €78,000. On 12 March, Smart Fashions sells textiles worth €1,000 at cost price to RIA on credit. The amount receivable from RIA increases the total assets. The stock asset, however, decreases by €1,000. Both sides of the balance sheet still total €78,000. On 30th March, Ben and Alex withdraw €6,000 each. The withdrawals reduce their respective capital by €6,000, which decreases the total liabilities. At the same time, the cash at bank on the asset side also reduces by €12,000. Both sides of the balance sheet now total €66,000. On 31st March, Smart Fashions transfers a profit of €4,800 from the income statement to the balance sheet. The profits transferred to the balance sheet are termed retained earnings, which increase the total liabilities by €4,800. These profits of €4,800 are after subtracting the depreciation of €560. The depreciation is a non-cash expense. Thus, the increase in the cash balance will be the net profit of €4,800 plus the depreciation of €560. Thus, an increase of €5,360 in the cash balance takes place. The cash profits increase the cash balance to €8,360. Moreover, the depreciation of €560 reduces the value of the assets. The details of depreciation charges were machines, €25, furniture, €200, car, €335, total, €560. Thus, we deduct €25 from the historic cost of the machines, which was €1,000. This gives the book value of the machines on 31st March at €975. Further, we deduct the depreciation of €200 from the historic cost of furniture, which was €10,000. This gives the book value of the furniture on 31st March at €9,800. Finally, the depreciation on the car of €335 is deducted from its historic cost of €20,000. This gives the book value of the car on 31st March at €19,665. Both sides of the balance sheet now total 70,800 euros. Summary. We will now have a quick recap of the important points. An increase in liability will correspondingly increase the asset, which would tally within the balance sheet. For example, the purchase of textiles from Sam Textiles. A decrease in liability will correspondingly decrease the asset, which would tally within the balance sheet. For example, the payment made to Sam Textiles. Sometimes an increase in one asset leads to a decrease in another asset with a similar amount and no change in liabilities. This also makes the balance sheet tally. For example, the credit sale of goods to RIA. Sometimes an increase in one liability leads to a decrease in another liability with a similar amount and no change in assets. This also makes the balance sheet tally. For example, a loan taken to pay Sam Textiles.